Hey, good people. Welcome back to Stock Up with Larry Jones. We have a minute before closing bell at the time of recording this. I just want to show you where closing bell ended up at, since we have such a volatile week this week, what's happening throughout the banking industry worldwide. We've had a bunch of banks come together and they're trying to save one of the key regional banks. As you can see here, you have some of the regional banks right there. And as you can see, the regional banks are coming together pretty strong. What we'll do right now is go into closing bell, and then I will come back to you guys.
Performers, but financials, obviously, for obvious reasons, up near 2%. Discretionary, up near 2%. Materials doing all right.
And it's about 70% upside volume, which is healthy, not overwhelming, but pretty good. Volatility index also down 3 points on the day. So that's got another decent spike on the chart. And tomorrow is a quarterly expiration. So we might have some of this exaggerated upside action just because of some of the maneuvering around that.
All right. We'll close not too far off the highs, green across the board.
You can't ignore the banks. It's the most important sector of the whole market. It's really foundational for everything. It drives the economy. So what happened starting last week is certainly very important. It's probably going to have some effect on psychology, if not actual underlying growth going forward. But I think if you kind of look back over the last few days between what was announced Sunday night with the new Fed facility, what was announced overnight with Credit Suisse, and then what was announced about an hour ago with the $30 billion deposit at First Republic, I think that's going to help to begin the repair process of rebuilding confidence in this group, helping to stabilize.
Do you remain constructive at these levels? Because you've been on our show in recent weeks, but this was also before we had bank failures and all the maelstrom around that industry right now. Would you still be buying at these levels?
Yeah, I mean, you can't ignore what happened with banks. Like I said, it certainly is very important. I don't want to be Pollyannish and completely dismissive. I don't agree with the analogies to 2007, 2008, but I do think the disruption is enough, coupled with progress that you are seeing on the data front, certainly not as quickly as the Fed wants, but you are seeing movement on the data in the right direction. So that, coupled with what's occurred with banks, is going to help to alleviate the aggressive monetary tightening that you've seen from central banks. That's going to remove a big headwind.
So all these banks came together and they decided that they were going to save First Republic. First Republic Bank was down. It was down as much as 24%, almost 25%. It could have hit that this morning, and it fought its way back. As you could see here, it is up 10%. So we're talking about a 35% gain as these banks come together and raise like $30 billion. All of these other banks came in to shore up First Republic Bank because they have to have stability in the financial space. Because if one bank goes down, they all look bad. And then there's a run on the banks because people do not trust the banks, right? So they have to reassure trust in the financial markets. As you could see, SVB, which was one of the banks that started this, and of course we had the Swiss bank, Squeeze Bank, the European bank actually defaulted also. So as you could see, you can't even, they don't even show a chart for SVB because the FDIC, the feds, actually took over the bank because they proved that they were insolvent. And so the government, as you heard, the president is guaranteeing everybody payment, that their deposits will be covered, even over the $250,000 FDIC guarantee. Follow? So we have a lot going on. That's why I played that video at length. So we have a few things that's going on. Let's check the market really quick. I'm going to make this one quick and to the point. As we can see here, the major indices. We have the Dow was positive, S&P and NASDAQ. The NASDAQ was up almost 2.5%. And so it had a strong close. It was actually negative pre-markets this morning. All right. So let's look at some of the major banks. They actually came fighting back because they are showing that they have stability in the financial markets. JP Morgan has, to me, it looks like they've performed the best through all of this, almost up 2%, followed by Citi, Wells Fargo, and then Goldman, right? I took a few notes here. I believe that tech is overbought because they have a ton of money on their, they have a ton of money. And when you have an environment with higher interest rates, then these companies need access to capital, or they have to have enough cash to last through the recession. And so I believe that's why tech was still holding strong. And I believe that energy is oversold. So I believe that tech is overbought and energy is oversold. I was listening to a CNBC report. The young lady, I don't know her name. I agree wholeheartedly in what she's saying, which means that there could be soon a reversal in both, meaning energy will most likely go up and then the tech will cool off. So I wouldn't chase in the direction that either of these are going, meaning I wouldn't chase tech up at this point. I believe is too high. And if I was going to buy anything, even though it's not performing well, I would go out long, but I would put energy on your watch list. Now, I am losing money in an energy play right now, though it may have been up today. And I had two. I had Devon Energy. Let's see if I can pull those up. And I had EOG. And they were not performing well all week, but they are performing well today. Let's see if we can pull up Devon. There we go. And here we go. As you could see, they are both doing well today. EOG and Devon Energy are both doing well today. So making some of my losses back. All right. And then as we could see here, I just froze this. FedEx just reported right at closing bell. They have a revenue miss, but they have a beat on EPS. That's what I was saying. It was estimated at 22.74, but it came in at 22.17. So that's a miss. But they had a beat on EPS. And the stock was up almost 7%. Actually, it was up over 7% at closing bell. Now, for those of you that don't understand why banks are suffering, like I said earlier on my live, banks are not doing well because of higher interest rates. And the reason why is they had a lot of fixed loans out, right? So if you bought a loan for your business, or you bought a loan, an auto loan, or you had a fixed mortgage rate, and that rate was fixed, but the Fed continued to raise rates, then the banks actually lose money, and they were not solvent, okay? And so they were just paying. So the Fed raising interest rates has broken the banking industry worldwide. And for those of you that don't think other banking in other countries don't affect here in the U.S., then I challenge you to go back and study, because this is a world market. Now, all of these banks came together today just to show you guys, to shore up that same thing happened in Europe, except the Saudis said, no, I'm not putting any more money in. That's a whole nother story. But all of these banks came in to save a regional bank called First Republic Bank. I'm glad they did, because I was down horribly, and now I'm looking much, much, much better. All right. So we're going to leave it right there. I just wanted to give you guys a brief update. I went live earlier today. It was quite lengthy. I'm going to leave it right there. This video is sponsored by Stock Up U, Stock Up University. I'm going to keep pounding it. Now is the time to study. Now is the time to study. I believe that we are already in a recession. I believe that the recession started in January of 2022. And I do believe that we are seeing signs that we have another leg down, because now we can clearly see how fragile the entire market is, and how the entire market is a house of cards. All right. So make sure you check out the top 2 links below, and we will see you later. Live, love, laugh, and learn.